In your most recent memo, you said now is no longer the time to be cautious. It's no longer the time for investors to be defensive. How offensive should investors be?
Well, first of all, Erik, things are changing so fast nowadays. You're quoting from a memo that came out a week ago. So when it starts with the word now, we're really talking about then, not now. Things change radically. I want to clarify that what I was saying, you've had me on the program many times in recent years, and generally speaking, I've been arguing that investors should have been tilting toward defense. I think that the key choice in a portfolio is whether it is more defensive than offensive or more offensive than defensive. I've been arguing for defense. The point of that memo, calibrating, was that we have to adjust our stance for conditions, and that those who were defensive no longer should be as defensive. People leave out the first part, and a lot of response was, "Oh, Howard Marks says buy." And I want to make it clear that I was speaking expressly to people who had been defensive. I wasn't telling people who were aggressive to become more so.
Now, you make a very good point, Howard, about how quickly things are changing. 2 weeks ago, the S&P 500 was down more than 30% on the year. Today, the S&P 500 is down only 15% on the year, and high-yield spreads have come in more than 300 basis points from their highs. How has that changed the risk-reward calculation?
Well, I thought at the lows, which were reached, I believe, on March 23rd, that the risk-reward ratio had become significantly in favor of reward. The lower prices go, the more the potential from a rebound, and the less the potential for further declines. So I thought at that point that the ratio had become very favorable. Today, obviously, less so. And as you mentioned, about half of the 34% that the market had declined between February 19th and March 23rd has been made up. So, by definition, half the potential is gone, roughly, and risk has returned.
Is it possible, Howard, that the very best buying opportunities of this crisis are behind us?
It's possible, Erik. It would defy comparisons to the past, and for the most part, all we have are comparisons to the past. We don't have knowledge of the future. By the way, knowledge of the future is the current working title for the memo I hope to get out today or tomorrow. We don't know what's going to happen in the future. We work off of analogies to the past, and in the past, compared to the past, this is a rally of record speed and proportion. And if you look at the past, most rallies in the middle of bear markets have been followed by subsequent declines. Usually, markets don't rally straight up.
So it wouldn't. It sounds to me. I don't want to put words in your mouth, but it sounds to me as though you wouldn't be surprised if these levels didn't hold, and markets were to, if not necessarily retest those March 23rd lows, sell off from where we are right now.
Yeah. Well, I mean, I wouldn't be surprised. Having said that, of course, I do believe that we need be less defensive than we were 6 months ago or so. But no, I mean, since past rallies have always been interrupted by past retreats, then I don't think you can say I'd be surprised if it happened this time.
Howard, you recount in your latest memo how aggressively Oaktree bought debt in the first few months of the financial crisis back in 2008, before the ultimate lows were reached in March of 2009. How much has Oaktree put to work since this crisis began?
Well, I can't give you a number, Eric, and I can't, as part of a public company, I don't want to disclose information that hasn't been generally disclosed. But I'll merely say that we were strong buyers in the month of March. And in the panic or the motivated selling that accompanied the virus, there were good buys to be had.
Do you know whether Bruce Karsh, your co-chairman, Jay, the CEO, everyone else back in Los Angeles were able to buy as much as they wanted? There was a lot of forced selling, and many securities, as you pointed out, were selling at steep discounts, at the very least, to where they had been only weeks earlier.
Yes, that's right. Bruce did a great job, and he was a substantial buyer. At the time, and by the way, back in 2008, Bruce and I were going at it all the time. Well, I think we're going too fast. No, I think we're going too slow. And you vacillate. Buying in the midst of a cascade downward is always challenging and always introduces mixed emotions. So, we bought. We tried to calibrate. We tried to buy a lot, but be disciplined so as to have money left for the next day, and so forth. But I think that we're happy with the events with the buying of March.
Howard, the Fed is now buying fallen angels, along with a whole lot of other non-government debt. I'm almost getting confused by the scale, and depth of the Fed programs. But what it makes me wonder is whether you ever thought you'd be competing with the Fed to buy junk-rated debt.
Well, I certainly never thought so. And 2 months ago, I think it was maybe 2 months ago today, I was at a dinner with one of the Fed presidents, and he told me directly that the Fed would only buy government securities. So I'm surprised. And I'm not sure I understand the reason, Eric. But, I shouldn't say that. The reason is to restart the markets and get them headed north again. But, the trade-off is the introduction of what we call moral hazard, the bailing out of people to keep them from suffering the consequences of their behavior. And I'm not persuaded about the value of that trade-off.